Hey everybody, let me get this switched over. The single most important thing right now is, make sure the audio is right. Single most important thing, do not trade the first two bars of the FOMC report. And it can be really enticing to want to do that. But if you trade the first bar and you look over the past however many times you do that, it really is not worth it. I'm going to turn the screen off really quick and turn on the pointer. And then in a minute, I'll pull up some of the encyclopedia. So look at bar 55. And what do you notice about the bar? Big tail above, big tail below. It's a trading range bar. We rallied, we went above, we went below. Better to wait and see what kind of follow through either side can get. The bears, they want to sell off, pull back, and sell, and a second leg down to this gap right here, or yesterday's high. The bulls, they want to get a rally back up to the October the 3rd low. Let me just change this. But so far, it is a neutral FOMC release. Most of the time, the FOMC goes sideways. And while we're waiting for the market to do something, I want to say a few things about the FOMC. The FOMC, for a lot of traders, I really don't think you have to trade the FOMC. It can be exciting. It's a big report. It can move quite a bit. But the reality is, if you're risking significantly more than you normally would on any given bar, that's a problem. Bears trying to get a bear bar and a sell-off back to the open. You see, notice how we tested the open of the day. We came really close on bar 39, but we did not reach it. So we may have to do that right here. I'm neutral right now with this FOMC release. At the moment, looks like we're going to test down. You can see we tested the top of this channel right here. We had a spike, pull back, 2 pushes down. We broke below the bottom of the channel, and then we rallied for 2 legs, testing the top of the channel right here. So are we more bullish? Are we more bearish? Every few minutes, it's a bear bar, and then it turns into a bull bar. So it's just really important. Don't buy the close of this bar. Don't sell it. Wait for more information. But back to the FOMC. It's very tempting to want to trade and be really eager on the FOMC, hoping for a really big move. But the reality is the FOMC only happens so many times in a year. So a lot of traders, I think it's a good idea for a lot of traders to treat the FOMC as kind of a vacation. Just take the day off, do something else, work on something, work on a project, study the Brooks trading course. It's so easy to get chewed up on the FOMC. On the daily chart, as many of you know, I've talked about this target right here, the October the 3rd low. And we're really close to it. And chances are we're going to get there. Are we going to get there today? I don't know. We came within a few points. Let me just adjust this really quick. Let's make this more of a regular green for now. You can see we came within 48.5 and the low of this bar, 51.25. So about 3 points. So a bear bar, but look what happened. Traders bought it. Just get this back to where we can see it really quick. So look right there. It's an inside bar. Is it a better buy or sell above the bar? Who can tell me really quick, either in Discord or the webinar question box, Is an inside bar a better buy or a better sell? For the bears, they'll see it as a wedge or a second entry sell. What's the significance of inside bars? And there should be one, it's a two-word answer. And something really important to remember. Okay, Gold Yard got it right. Trading range. Inside bars are trading range. Whenever you see an inside bar, you should always remember it's a trading range bar. No matter how tempting it is to want to sell it. And the reason I say that is trading range bars have a greater probability of it's a breakout mode situation. So it could break out below, it could break out above. For the bulls, would I buy below 56? I think the problem with buying, for one, the problem with buying below 56 is the market already rallied to the midpoint of the bar. And I think you have to respect the possibility of a second leg down. This open of the day, I think this is really subtle but important. The open of the day is 21.5, and the low of 39 is 22.25. So we came within 3 ticks of the open of the day, and that makes me question, is this an adequate test of the open of the day, OOD? I am flat. I have not done anything since over here. By the way, I will host an end of day review at 3 o'clock, as many of you have seen either in the trading room or on YouTube. And I will answer questions, and I will look at periodic questions here in just a few. So let's take a look at some of the FOMC slides that Al has created. I'm sure Rose has shown quite a few of these already. But let's let that load and look at a few more. Alex the Kid asked, inside bar, does the direction matter? Direction of an inside bar compared to the prior bar of a trend? Well, Alex, let me ask you something. In a trading range, what does Al say about a trading range? A trading range is either a continuation pattern, like a pullback, or it's a reversal pattern. And it's always dependent upon the context. And let's look at it from the perspective of maybe a 1-minute chart. I'm going to keep it actually minimized because I don't want TradeStation to mess up on me. But you see what happened right here? Big bull bar, big bear bar, rally, sell off. And this is the question. Is the sell off going to win, or is the rally going to win? That's what everybody's deciding on right here. 60-minute chart, spike, and we've channeled. You can kind of see the bottom of the channel. There's the top of the channel. We're breaking above it, and then we sold back off into the channel. Again, I would assume that we're going to have a trading range for the FOMC until we get something strong. By the way, whenever you're trading the FOMC, I think it's really important to have a 20% position size. So if you trade normally 10, if you trade an E-mini or 10 micros, I think most traders should go down to trading 2 micros. If 57 is a bear bar closing on its low, that'd be a decent entry bar for the short below 56. But I think the bears need to do more. So ideally, if I'm going to look to sell, betting on a test of the open of the day and a possible test of yesterday's high, I'm just going to make this blue. I really want 57 to close on its low. Are we always in long or always in short? I think right now, we're trying to become always in short, but it's not yet clear. If 57 is a bear bar closing on its low, I would certainly get out of longs. Bears will sell for a swing, taking a chance we test the open of the day and yesterday's high. Looks like the bears are going to win. So for the bulls, I would consider getting out of shorts here. I would consider getting out of longs. So it's a sell below 57, stop above 57, betting on a test of the open of the day and yesterday's high. It's a swing short. The traders that are selling here, they're selling trying to catch the move. Now, what do the bears do if 58 closes on its high? Then they'll conclude that maybe they're wrong and they'll look to get out. It's not yet high probability, but traders will begin to sell, taking a chance that we get a downside breakout. You see the hesitation on 58? We're about 40 seconds into the bar, and the bears are having trouble getting the downside breakout. And the bulls, you have bulls deciding what to do here. Some bulls, they bought the 56 low, scaling in more below 55. And you can see a lot of those bulls are starting to give up. They buy this low, they buy more. And part of that bounce was them deciding what to do here. I sold below the prior bar, taking a chance that we test the open of the day and possibly yesterday's high. My default when I'm trading, as many of you know, is always in. So when it looks like it's always in short, sell below a bar. And if I can't make up my mind, just wait for the close of the next bar. And you can see what's happening here. We're testing near the lows and we're finding support. So is this a close enough test of the open? 22.5, and the open of the day is 21.5. We came within 1 point of the open and we're starting to reverse up. That's fairly disappointing. I ended up getting out at break even. That is not what I wanted to see. So why did I get out at break even? Because when the market sold off below 57, the low is 25 even, and the low of this bar is 22.5. So bulls were able to make 2 points, but they could not make a 3-point scalp. And then if I'm selling, hoping for a downside breakout, and then the market starts to reverse, that's a problem. You can see what happened here. It's very subtle, but it happened pretty quickly. If we look at a 1-minute chart, we started to break below, we got follow through, and then we started to reverse. Whenever I'm in a situation like that, where the market goes down and starts to reverse back up, and I'm a little bit leery, in other words, I'm a little bit concerned, it might be the bottom of a trading range. If the market starts to turn up right around my break-even price, basically the close or low of the bar, I'm usually just going to close the trade. I'm not going to try and exit with the limit order. I'm just going to take the, either the 2-point profit, or excuse me, the 2-tick profit, 2-tick loss, and just move on. When you're disappointed with the trade and you're taking it for a swing, you automatically know whenever you're taking anything for a swing, remember the golden rule. 40% chance you're going to get a big breakout. 60% of the time, you're going to make a small winner or a small loser. So one of the keys with swing trading is not taking a real big loss. So if you sell below 57, hoping that 58 crashes to the downside and it hesitates and then it starts to reverse up, guess what? Just get out of the trade. Take the small loss. Who cares? Don't wait until you're all the way up here and just clinging onto the trade, hoping that, hey, maybe this is, maybe this will turn back down. It's got to turn back down. It doesn't have to turn back down. We can easily, this might be the first leg, a very complex pullback, and then a second leg. Let's take a look at some FOMC pieces. Now, I mentioned the market was probably always in short on 57. Now, probably always in short does not mean definitely always in short. And because of that, if 58 is a bull bar closing on its high, I think those always in bears have to get out of the trade. So here's FOMC possible outcomes. You can see doji and then a strong downside reversal and then a spike and channel. That's not what we have today. Big outside up bar, deep pullback channel, not what we have today. Rally and then a reversal. So let's look here. Does this look like the start of a strong trend day? No. I think it's okay to exit shorts above this bar. And aggressive bulls will buy, taking a chance that we're going to rally into the opposite direction. So I think always in bears probably exit above 58, even though it's a big bar. We've tried to touch the open of the day 3 times and failed. And at some point, traders begin to question if we're going to go the opposite direction. We had a bull breakout on the first minute of the FOMC right here. And these bulls never got a chance to get out. And they bought a breakout. They bought something reasonable. And because they bought something reasonable, you have to wonder if we're going to have to test somewhere up here. So if we start to get a bull bar closing on its high, maybe we'll test back up to this area in the top of this tail. Every tail is a failed breakout. I did buy above the prior bar. So I'm taking a chance that we rally and get the upside breakout. But I'm going to pay close attention to this current bar. What do I want to see on this current bar? I want to see the limit order bears who sold above 58 get trapped. I want the bulls who bought above 58 to not scalp out for a 2 or 3 point scalp. This is already disappointing. So the bears, they sell the high of 58 at 29.75, and the market went up to 32.5. So not quite 3 points. Looks like it went up exactly. It went up 2 points, allowing the bulls to make a 2-point scalp, and now we're hesitating. That is disappointing. Some of the bears, they sell the high, 29.75, and they scale in 2 points higher. The longer this bar hesitates near the high of 58, the more traders will be willing, the more traders may begin to exit around break even. And that's how I feel about this trade. If I'm long above 28, the more it touches my entry price, the more I'm going to bail out of the trade. And the more I'm going to think, this isn't acting properly. I'm just going to take whatever profit I can get and move on. So why does that happen? It happens because if you think about a good swing trade, this is good for the bulls. Looks like you have limit order bears who sold above 28 getting out. So why do you want the market to rally? You've heard Al mention that if you buy above a stop entry and the market gives you several opportunities to enter at that same price relative to that stop entry, that's a problem for the swing traders. And the reason for that is that's a sign that nobody's trapped and the market is not forcing traders to chase the market. So if I'm long right here, I want people to get trapped out of this trade. I want bears trapped into a losing trade, and I want bulls trapped out of a winning trade. Because if the bulls are trapped out of the winning trade, guess what they have to do here? They've got to buy to figure out how to get long. And the bears, they've got to figure out a way to buy back shorts. One of the things that can help you with stop entries and breakouts is learn when limit order traders get trapped. Limit order traders drive the market. So what does that mean? That means that when limit order traders get trapped, and limit order traders are traders selling above bars and buying below bars for scalps. When they get trapped into a losing trade, it causes a swing. So all the bulls that bought the 20 low or the 18 low during 21 or 22, guess what? They got trapped. They tried to exit on this pullback, and that led to 2 legs down. And that's what traders are hoping for right here. So if you're a bear and you sold the high of 27, you sold the high of 58, this bull bar right here, and let's say you scaled into 2 points higher, 3 points higher, it doesn't really matter. What are you thinking right now? You're questioning the premise on the trade, and you're questioning whether or not you should exit the trade. So the more this bar closes on its high, the more disappointed the bears will be. And that as a bull, I'm still long. I'm taking a chance that we break out to the upside. I want to see how this bar closes. Okay, tail on 59, not terrible. So probably always in long with 58 and 59. Strong enough breakout, we'll probably get a second leg. Next, bulls will look for, will the market test the 58 high? So let's see. Can the bulls get a strong follow-through bar here and create a gap? The high of 58, low of 60. Will the bulls eagerly buy the close of 59? Or will the bulls look at 59 and say, wow, what a gift for a quick profit. I'm going to sell. So while we're waiting to see what this bar happens, who can give me a short answer as to why does Al in the video course say that beginners should learn how to swing? I'm just curious for some of the answers that people have. And there's a couple of them. But I think it's a very important subject to discuss. Because scaling is hard. I mean, that's an answer. Not quite what I'm looking for. Better chance of probability. Okay, I like Steele's answer. because scalping requires a high win rate. So what do we see what happened right here? We'll talk more about that in a second. You have some bears who sold the high of 58, and then they scaled in higher, and then 60 was an attempt to get out break even. So they sell this high, they sell 58, they scale in higher, and they try and get out break even at the 50 high. The bulls know that. They're not stupid. So what do you think the bulls did right there? The bulls just loaded up on more of their position. Can't really see it on a 1 minute chart. So I'm still long, and I'll probably take part off near the high of 55. Now, why the other target is that I'm thinking through is the October 10th low, 51.25. I think that's a logical target for us to reach. It's such an obvious magnet on the daily chart, and bulls bought the low, scaled in lower. I'm going to fix this. I keep forgetting that for some reason TradeStation does not like it when I flip to the daily chart. Anyways, I'm still long, and I'm going to hold to see what we get here. But back to the reason why traders should swing trade. The reason is, there's a few reasons. One is obviously probability. I like Steele's answer regarding that you need a high win rate to scalp. All of that is true. The other reason why traders need to learn how to swing trade is the reason why swing trading is so important is you have to know how to swing trade in order to be an effective scalper. So what does that mean? You have to understand what a major and minor reversal is. The swing traders are kind of kings of the market, if you will. I'm sure there's a better way to think through that. But if you don't understand where traders have to get out, then what you'll inevitably do as a scalper is you'll scale in right where traders should not be scaling in. So let's look at an example. Something like 21. If 21's breaking to the downside, it's flipping the market to always in short. So if you're buying all the way down here and you continue to scale in, you could sit through a lot of pain. A better example, by the way, is that I'm long, I'm not happy about this. We had a trend line break and then a rally. That is fairly disappointing. So because of this bar hesitating a lot and it's getting close to these highs, if we start hesitating for too long, I'll start selling out of my position, which would be right around the close of this bar. But by swing trading, you'll get better. You'll naturally become a better scalper. So like right here, if you sell above 46 or during 47 and you start scaling in, you'll get trapped, and then you have to make a difficult decision. If you start selling and scaling in all the way up here, that's a problem. That's why I try and follow the always in direction, because it can be a great guideline as far as what to do. So I'm selling part of my position above the high of this current bar. Why would I take part off above the high of 60? Who can tell me why I took partial profits above the high of 60? There's a reason. I'm buying 58, hoping for a breakout. 59 is decent follow through. Why would I take part off if I think the market might go to the October 3rd low? Why would I take part off at 60? Top of the range, we're in a trading range, big tail. Okay, those are good answers. Whenever you're buying and you see a doji is a sign of hesitation. I don't want to buy high if there's a sign of hesitation. Now, what I think is a reasonable thing to do that a lot of traders should do is, if you're long, take part off. Plus, my risk was fairly small. It was pretty much the low of this bar. I took part off, but I'm still long at least a portion, just in case the market continues higher. But a good practice is whenever you're disappointed, start taking partial profits. Bulls breaking out to the upside. So far, this is looking pretty good for the bulls, and it makes me think we're going to get to the October the 3rd low. One thing that I want everybody to write down, especially those that are new in the trading room, that have not listened to us or heard me say this that often. I think there's one pretty good rule that a lot of traders can follow that will really help them with trading, and that's leg counting. So there's really 3 rules to leg counting. One Never fade the first leg. So what's the first leg? Whenever you get a breakout like this, strong breakout, follow through, it's a strong enough breakout to be a surprise. Do not fade the first leg. So in other words, high probability of a second leg down. Whenever you have a third leg down, like leg 1, leg 2, leg 3, this is the third leg, do not trade in the direction of the third leg. Because if you're trading in the direction of the third leg, there is a higher probability of a reversal and a test of the top of the leg. The second or the third rule, and I'll discuss more of this in a minute. The third rule, and by the way, I'm still long here, and I'm just trailing, so my stop's just below the bar, and I'm going to trade it kind of like Forrest Gump and just see what happens. But anyways, that third rule is whenever you, in the second leg, if it's in a trading range day, do not scale in. So in other words, we have a rally to 42. That's leg 1. We have a pause on 43, and then 44 and 45. That's a second leg up in a trading range day. And when there's a bear bar closing on its low. Whenever you have a second leg up in a trading range day like this, don't scale in below the bar. Just get out. Why just get out? Because in trading ranges, it's really common to get 2 legs up and then reversals. If those 3 main pieces did not make sense, comment and I'll talk more about it. So for those of you who don't know, the Forrest Gump trading analogy is something that Al would always talk about. Al used to joke and say Forrest Gump would make more money than Albert Einstein, because Forrest Gump, he would look at 61 and say, yeah, 61's breaking out to the upside. I need to buy. Or 21, it's a bear breakout. I need to sell. And Albert Einstein would look at 15 different charts or 15 different time frames and look at all these indicators, and he would waste all of his time getting analysis paralysis and not be able to make a decision. So what's the third rule? Mad Dog, let me just state the rules again. Never fade the first leg, which means there's a high probability of any breakout that's a first leg has a very high probability of getting a second leg in that direction. There's about a 90% probability. So when you get leg 1, there's about a 90% chance you're going to get a second leg. It doesn't have to be symmetrical, but it's a 90% chance. So if you get a breakout such as this that you might think is strong enough to be a first leg, high probability of a second. Here, in this case, it's a bear breakout. There's a very high probability of a third leg. So good bar for the bulls. Let's see what the follow through looks like. Whenever you get these big bars in a trading range, normally it leads to sideways trading. So if I had to guess, we'll probably hesitate for a bar or two, but there's no way I'm selling this. It might be a second leg trap, but with the magnet just above the October 3rd low, I really don't want to sell it. Anyways, the 3 rules. The first one is never fade a first leg. The second is whenever you have a second leg down, do not, and especially in a trading range, don't scale in below it if you get a bear bar closing on its low. So right here, 2 legs up, don't fade this. So what do you think's happening right here? You have a lot of traders who are disappointed. Traders bought the close, the market rallied, and then traders started selling. Possible wedge. 1, 2, 3. So why not sell the close right now? Because this is a trend line break on a smaller time frame. I do not like how this bar is moving around as much as it is. We rallied, bull bar, deep trend line break. That's disappointing. That will probably lead to more sideways trading. I added on the close of that bar. Remember what I said? I said that I bought here. I took part off above this bar. I added back the position here, but when this bar raced down like it did, and then it retested the close, I took half off my position again. Why did I take half off? Because I don't like deep pullbacks, especially in a trading range day. I still think we're going to get to the October 3rd low, but I'm disappointed enough that I do not want to have a full position. By the way, for those silver, someone makes a good point. If someone private messages you about some sort of any sort of program that's really not affiliated with the Brooks Trading Course or has not been vetted by the Brooks Trading Course, and an easy way to think through that is if someone's offering you something and you can't find any information about it on the Brooks Trading Course, it's probably a scam, especially, use common sense. There are issues with that in the Discord channel. So just use common sense. Obviously, disappointing. 3 pushes up, 1, 2, 3. And by the way, that third rule is don't fade the third leg. What are the chances this is a wedge? 1, 2, 3. It very well might be. My only concern about the argument of a wedge is the strength of this move. This is strong enough. I think we'll get a second leg up. Here's the 1-minute chart, by the way. Tight bull channel. Outside bar, tried to get a second leg down. The concern that the bulls have is this up here. Climactic bar, pullback, second leg. Obviously, this is not behaving all that well. So if this is a big bear bar closing on its low, I think a lot of traders will get out. You can see right here, it's bad high 1. So traders are selling as this bar is going up. I'm flat. So do you see? It happened reasonably quick. But in the first couple of minutes of this bar, you can see we rallied and we had this big outside down bar, and then we retested the highs. So you look at this bar and you think to yourself, wow, the next bar is a really big bear bar. That sucks if you bought the close of 61 and now you're trapped. But if you really look at the bars, and we can see it on a 1-minute chart, the market actually sold off. Let's see, the low of this bar was 37.5. So the market actually sold off to right here in the first minute of this current bar, all the way right here. And then the market rallied up to 46 point here, all the way back up here. So if you bought this close, in the first minute you're disappointed, in the second minute you could have gotten out break even. What do traders do here? I think this is a big enough bar that a lot of traders will bet on a second leg down. And that damages the probability for the bulls getting back up to the October 3rd high. So it's a little bit disappointing for the bulls. What do the always in bears do? Or what do the always in bulls do? That is pretty tough. Someone asked, is Richard's course affiliated with or endorsed by Al? Al and Richard actually made the course together. And so it is affiliated with Al, and it's not part of the Brooks Trading Course video course, but it is still an affiliate, if you will, of the Brooks Trading Course. So that's different. But that course is it's a 6-hour course. It's the same concepts, just 6 hours of the actual Brooks Trading Course. And it's a good starter package, if you will, like a starter intro to the Brooks Trading Course. But you're ultimately going to need, if you really want to learn the Brooks Trading Course, you ultimately need the Brooks Trading Course. But it's great to have both. So what's happening right here? Well, see this? We sold off, disappointed bulls. They try to get out break even, and then we went down. High 1 buys. Who can tell me? I've mentioned this several times over the past couple of weeks. I talked about high 1 buys right here. But before I go into that, better to wait and see what this bar looks like. Probably going to test the open of the day. So trading ranges can be just really ugly. And that's why I think most traders should just step aside. It's just not really worth it. So high 1 buys. I mentioned that a high 1 buy, why do most high 1 buys and low 1 shorts fail? Can anyone tell me that? So in other words, when you get a high 1 buy, why is it that there's more often sellers above the high 1 than buyers? If you've listened to me long enough, I've talked about it several times. Testing the open of the day, so you'll find some profit taking here. Sellers above who are stuck. Rambo's pretty close to the answer. I like that answer. If you think about it, bulls buy the close, and it's buyers that are stuck. But I get what you're saying, Rambo. Bulls buy the close up here, or they buy during this bar, and they're disappointed. They scale in lower. What are they going to do on the retest? Well, if traders are very disappointed by the retest, they will sell as the market's going up and take profits. That's why a lot of high one buys end up having sellers above. This doesn't look like a high one, but it is, because it formed a lower high with this part with up here. So what's going on right here? Bulls are buying at the open of the day. This is what I mean. This is what I meant by FOMC days. They can be really, really just ugly. I have a 1 minute chart up. Do not trade the 1 minute chart. I'm using this for illustrations. In other words, the point I was making is 62 did not just race down and reverse 61. It first went down, broke a trend line, and then retested. That's what I meant by almost every bar, every breakout has a second leg. Sometimes it's just hard to see it. Someone asked, where did I cover my long? I mentioned that I added on my position here, and when this bar went down, I took part off at the close of this bar. However, I was still long half, and I was too slow, and I ended up getting out for a loss down here. And then when this bar closed, I ended up going short, and then I took all off somewhere down here. When it started going down, I just hit close the trade. This is a very disappointing day. And that's really important with an FOMC day. All of these breakouts are just vacuums. So the market starts to go up and everybody stops buying, and then we just vacuum down. And then we get to the open of the day, everybody stops selling and everybody starts to buy. It's really important. I remember hearing Al, let me see if I can show the FOMC or the day. It was a gap up and a sell climax day. So bear bar, but a really big tail. Probably buyers not far below this bar. But this might just be a pullback, which means if it is, we could still go to yesterday's high. But I think we're probably going to pull back, test the 62 high, maybe the 61 close. Let's see if I can find this day. So it was a gap up. Here it was. I remember, I don't know if this was the actual day, but it was pretty close to it. And he used this actually as an example. So for those of you that were in the trading room long before the encyclopedia was ever created, you remember Al used to just have a workspace that he would just pull up. And he would just pull up workspaces on TradeStation. But he mentioned how, he said it's really important for traders to learn that most breakouts are just vacuums of support and resistance. And what that means, someone asked what a vacuum is. A vacuum is just when everybody steps aside, the market reaches support, and then it rallies. So let's talk about a vacuum. Round numbers are vacuums. Breakout points are vacuums. This is a vacuum. So think about the bulls. Let's just pretend you're an institution. You're an institutional bull. I have this channel at the top drawn because if this is a channel and this is a failed breakout of the channel, a logical target is the test of the top of the channel up here. Anyways, if you're a bull, let's say you bought the October 3rd low during this breakout. So you bought this low and maybe you didn't scalp out here. You were hoping for a rally and test at the top of the channel. What are you thinking if the market sold off here? You're going to be disappointed. And if you're a bull and you bought the October 3rd low at 51.25 and the market sold off, 41, you bought the low at 42.50, let's just call it, and the market sold off 100 points pretty much to 41.50, are you going to care about getting out exactly at your entry price? Or, will you get out if the market reaches, if you bought here, scaled in 100 points lower, do you really care about taking a 10-point loss on your first trade if you're going to make 90 points on the second? Of course not. And that's why a lot of traders end up, and the bulls know that. So the bulls are selling out of longs near this price level, and bears start selling aggressively. I made the same mistake again. I'm really close to switching. For those of you that have TradeStation, I'm very tempted to switch back to the legacy platform, which is the older TradeStation platform. You know, it's not as nice in the sense of the one frustrating thing about the legacy platform is you can't do this. Here, you can just grab the axis and just move the chart around, which I know every other platform can do. And you have the buttons down here, so that's kind of nice with the new platform. But for whatever reason, the new platform on TradeStation, I guess it's TradeStation 10, there's a few bugs in it that are just kind of annoying. And the legacy platform, from an execution standpoint, is fine. So consecutive bear bars, probably going to get a second leg down. My only concern is the pullback is pretty deep. So here's the low, here's the high. That's a deep pullback. So if you're a bear and you sold the low close down here, it's going to beat me to it. If you sold here and scaled in, you're deciding what to do. You're probably going to buy back partial profits here, which means I don't think we're going to go straight down. I think we'll probably go more sideways, but I'm not interested in buying necessarily down here. It's enough momentum, and with it being an FOMC day, we can easily get a pretty deep sell-off. We're at resistance on the daily chart. We could easily form a bear bar closing on its low and test yesterday's high. So I think we're always in short, and it's probably better to be short than long. But the problem with being short here is the risk is pretty big. Okay, question. If possible, can you describe the rule? Something similar to during a trading range day when you see a second leg, don't scale in. Yeah, the rule is this. Let's just go to, by the way, I use the encyclopedia. The way you use the encyclopedia is, one, you got to get proficient in the video course. So you got to be able to speak the language of the video course, understand the Brooks price action terminology. This is my problem with being short here. I think it's a trading range, so there's going to be deep pullbacks, but I don't want to buy here necessarily. So I'm kind of trapped out. Anyways, once you start to understand the terminology, you've seen the videos maybe once or twice. The next thing I would do, take the Google sheet and start studying all of this. And what I mean by studying it, just learn where things are. Hey, here's stuff about always in shorts in part 1. Here's all the gap up, gap down scenarios, and just learn where the titles are. If I want to find traps, I know there's a section on trading range days, section on traps. And then, I didn't mean to close out the tab I was in. I'm going to let that, here we go. I'll go here. I know there's a trap section. The trap section. Here's a second leg bear trap. But these look like successful ones. I don't want successful ones. I want, here we go. Whenever you get clear something with 2 legs down, and second leg traps, usually whenever they have strong sell-offs, leg 1, pull back, leg 2, a strong second leg, and then you get a decent bull bar like this, most traders are better off not fading. Don't scale in. Just get out. And if you do scale in and you get consecutive bull bars, just get out, because there's too much risk of 2 legs up. So that is the rule as far as the second leg. I'm looking at the GoToWebinar questions as well at the moment. Yep, expanding triangle. What is the significance behind expanding triangles? Who can give me that answer? Breakout mode, trading range, so a lot of reversals. It might be a reversal or continuation. People are saying breakout mode. Yeah, all of those are correct. An expanding triangle is a breakout mode pattern. That is exactly correct. And whenever you're in a trading range, you got to be really, really careful about what the market's doing. And whenever the market is in a trading range, just step aside. Because this could easily just be a pullback and then a reversal all the way back up here. So remember those bulls who bought the close of this bar? Trading range day. Remember what I said about the bulls who bought the high of 55 during this pullback? I mentioned that those bulls will probably get out. Well, guess what? The bulls who bought up here, scaled in, they very well might be able to avoid a loss. Oh, sorry. I realized I was on mute. Someone asked about the trading room. How do you guys do the trading room on a weekly basis? If you go to the Brooks trading course, there's a schedule. So if you just scroll, click here, just scroll down. Every month you see it right here, and it gives everybody the times they're presenting. So for me, I'll typically talk Tuesdays and Fridays most of the time, and then I'll talk in the afternoon. So I'll talk around 12 Eastern, and I'll do an end of day review on those days in the trading room. And then Rose, when she talks, it's typically in the morning, but sometimes she'll talk in the afternoon. And she'll typically talk till about, I think it's 30 minutes before the market opens, and then she'll talk till about 12 to 12:15 Eastern time. Anyways, back to the question. Someone asked about, can I talk more about the third leg? And I will in just a second. The third leg rule here, we're reversing up and we're trying to test this blue line. And again, don't be fooled. We could still test the October the 3rd low. Although I think this bear breakout here is strong enough for a second leg down. But I'm a little bit hesitant to sell here because I think we could test the close of this bar. I'm flat. My last trade was selling the close of 62, and I scalped out here. But I'm a little bit, to me, the probability is too neutral here. And the bulls are gaining some pretty good momentum, which makes me think we may rally here. And I don't want to buy high. I know the bulls who bought here are trapped out of their position. So I might be a little bit trapped out of the trade. Anyways, someone asked about why do you fade the third leg, and why should you not trade the third leg in the direction of the third leg? So who can tell me? A channel is a transition point between what? The channel is a transition. Channels into trading ranges. Yes, trends to trading ranges. So a channel, it never looks like it at the time, but when the market has a spike and then a pullback, it's in the channel phase. That channel will eventually evolve into a trading range. We've seen this on the daily chart. Here's an extreme example. Spike, pullback, channel. Well, look where we are. May 4th low is the bottom of the channel, and we tested it. I'm getting close. I'm about to just delete the daily chart because I keep clicking on it. And every time I click on it, I've got to play shuffle. Okay, this one wasn't so bad. By the way, when I'm trading, I normally don't keep all of these charts on here. I use them when I write the blogs, but for me, when I'm trading, it's one chart in a matrix. Pretty good breakout for the bulls. But remember what I said on the 60-minute chart right here? I said a high one buy. There might be more sellers above. There might be more sellers here. But the bears already got a second leg down. And that will increase the probability for the bulls. So look what happened. You bulls bought the close, they bought more below, and they made money. So is it a sell up here, betting on another trap? I would not. For me, I think the October 3rd low is unavoidable. And I think the market wants to get there. Let's take a look at a 1-minute chart. What do you see about the 1-minute chart? Pretty decent breakout bars. So that's good for the bulls. I did buy, and I'll be pretty quick to exit depending on how the market reacts in the next couple of minutes or seconds. If you're long, if the market starts to pull back, you want traders to immediately start buying. So this is a trend line break of this 1-minute chart. And if it stalls for too long, a lot of traders will begin to exit back at the highs. So you can think about it. Tight bull channel. We have a bear bar, and there's that tail, so that's disappointment. We gapped up on the bar, close of this bar, 43 even, open of this bar, 43.25, so that's good for the bulls. I'm flat, I just took my profits, and there we go. So mission accomplished for the bulls. We reached the October 3rd low. If I can find it. Trading range, here's a trading range related question. When buying with limit orders using wide stops and scaling in, do you have a general risk reward ratio that you apply? If so, would you be able to go over a couple of examples? Trading range, the problem with trading ranges is trading ranges do a really good job of not allowing you to have great risk reward unless you're fading with limit orders. So the risk reward's always pretty difficult when trading ranges. A general rule for me, I think most traders should use stop entries. By the way, it's always in long here, and we're breaking out of a trading range. So, and it's an FOMC day. We could rally much further than this, but it's important to see how this bar closes. Anyways, back to stop entries in a trading range. For me, I like to think of trading ranges as 2 or 3 legs down and then reversals up. So it's kind of like a dance. We sell off, pull back, start of a channel, sell off for two more legs, and then we rally for 2 legs and test the top of the channel. And now we're in a trading range. We break out to the upside, get deep pullbacks. A good rule of thumb, try to buy in the bottom third of the channel and sell in the top third of the channel. And when you get big bars forcing you to buy high, if the follow through is not really quick, that's a problem. Bulls breaking out to the upside. Is there any reason to sell? I would not. I think it's better to, this is so strong that the market could rally for at least a couple of legs. But you need a wide stop, 55 all the way to 30. This is about 25 points away. This is about 25 points away. Yes, I trade with one chart in a matrix, but I have this workspace open on my other computer, so I can always look at it. Question. Brad, did you say don't fade the third leg? I thought you would say don't fade the second. Yeah, it's a little bit confusing. Don't trade in the direction of the third leg unless it's a small pullback trend. If it's a small pullback trend, that trumps everything. But if you have 3 legs down in an overall trading range, when you see a bar like 38, if you're selling it, you have to know it's a third leg. And if there's any slight pullback, it's best to exit the trade. So in general, just don't even trade it. If you see a bar like 39, don't trade it. Here, when you see a second leg down, like 33 or 34, it's more dangerous of getting a third leg down. So in other words, like right here, high probability buyers below 42 for a second leg. But 45, 44 and 45, that's 2 legs up in an overall trading range day. And look where you are. You had a spike pullback channel. You're in the middle of the channel with a tail. And by the way, wait for this bar to close because it could have a pretty big tail. Here, if you're long and you get a bear bar, do not scale in all the way down because you could easily reverse to the bottom of the range. It's better just to get out below the bar. When you have a third leg down, it's better to not trade in that direction. So I hope that makes sense. Probably an okay buy. What do you notice about buying here? I'm going to give you a hint. If you're buying the close of this bar, which traders will, the risk they face is that there's going to be buyers that bears will make money selling the high of 62, this big bear bar. So instead of buying the close, you have other traders buying closer to the breakout point. Other traders buying closer to the breakout point. A matrix is just a price ladder. I just call it a matrix just because TradeStation has it called a matrix. Someone asked, how do they figure out how many points is in a scalp or a swing, depending on the market you're trading? That will always depend on the cost of the transaction. In general, most traders, most traders want to keep their transaction cost under 5%. That's what can make it a challenging at times if you're trading something like the E-mini, or if you're trading micros when the market's smaller. But ideally, you measure it from the standpoint of what's the bid-ask spread, what is your commission. So if you're going for 1 point in the micros, if your commission is $1.20 round turn, and you're getting $5, that's far too much commission. Therefore, the minimum scalp in the micros has to be closer to probably 3 points. And right now, when the range is really big, that's not a problem. So it's still always in long. Better to be long than flat. About a pullback of the close of 67, and the primary reason I bought the pullback of 67 is just in case we continue to go higher. I want to be in the market. Worst case, I'll get out if we get a bear bar closing on its low or something disappointing. So we're retesting the high of the prior bar. What will the traders do? Will traders exit at the highs, or will traders buy more? A little bit disappointing with 68 testing the high of 67. But still always in long. Part of my concern with being long here is the October 3rd low. There will be traders selling at this breakout point on the daily chart. Now we could easily go several points above it. The other problem I have is just the overall context. Trading range day, we're breaking out above a lot of highs. Chances are this is going to act as, chances are there's going to be sellers above today's high right here. So I think we're always in long. Market's probably going higher. We're probably not going to go that much higher. High one buy, but probably buyers above. Let me say it a different way. There might be sellers above 68, but if there are, there's probably buyers not around the midpoint of 68 for a second leg up. So we may pull back to the midpoint of the bar and go sideways. And that's really common for high one buys. But there's no way I'm going to sell above 68. High one buys are typically trend resumption patterns. Because we have an inside bar on 68 late in a rally with a lot of trading range price action, the market may rally for a bar or two and then pull back to the midpoint of the bar. And that enticed me. I took partial I just exited the trade here. I bought a pullback here, and because of the inside bar, part of my concern is we're going to have a hard time escaping the inside bar. We may go a measured move above, but to me, my problem is this. What's the probability we go all the way up here before we test the bottom of the inside bar? And to me, I think it's pretty close to 50-50. And I don't want to risk a lot. Here, the breakout's pretty big, and we're far from the moving average, and we've had a lot of trading range price action. In the overall context of just the past couple of days, here's a 30-minute chart. Spike, pullback, channel, breakout, pullback, another breakout. It's a possible measuring gap right here. So we can go a lot further than what seems reasonable. Measuring gap, we could rally all the way up to 42.76. But how far are we going to go in the next hour? That is the question. And to me, I don't think we're going to go all that far, that much further. Probably going to pull back. If you're long, you can always trail a stop. So you're long, maybe a stop below 68 or a couple of points below 68. When 69 closes, maybe you put a stop 2 or 3, 4 points below 69. Nothing wrong with trading that way. What about selling here, betting that we're going to test? What about going short here, betting we're going to test the October, the third low? That is a very dangerous thing to do, and there's just no way I'm going to do that. But overall, very impressive on the daily chart. This is a pretty good statement by the bulls. And this makes me think, this could be the low for certainly the rest of the year. We may rally, get a second leg. So this looks pretty good. Are we always in long on the daily chart? I think so. But it'll be interesting to see. We have a big bull bar near the moving average. What kind of follow through will we get? A lot of traders, I talked about this over here. I mentioned how you'd have bulls buying the rally and they got trapped, buying maybe a 50% pullback. They got trapped by the sell-off and the breakout below the October 3rd low. I mentioned some of those traders, they might be so disappointed on the trade. They buy in here, maybe 43.50, 43.25, 4,300, and they scale in lower, and maybe they buy more above a bull bar. Who knows? A lot of those traders are deciding, do they get out break even at their first entry or break even on the entire trade somewhere down here? Or do they look at this and they say, you know what? This is a trading range day. We may rally all the way back to this area. So maybe instead of exiting at my first position around 4,300, maybe I should hold and see if we test all the way back up to 4,400. So these next couple of days will be pretty important. You can see we're back to the high one. So traders sold the high one more than bought, and that was my concern. My concern is we may get close to 1 times the range, but then ultimately pull back. I still think the bears who sold the high of 62 and the high of 16 are going to make money. So to me, there's probably more sellers up here. What do? Do you buy below 69? I would not. I think it's better for always in bulls to exit. Why? Because it's still 3 legs up in a trading range. We rallied, paused, and rallied. Or you can call it a second leg trap. The point is, in a trading range day, you can get just very, very deep pullbacks. 69 is also enough of a surprise that it may get a second leg down. And what that means is 69, if 70 forms a high one like so, there's probably more sellers above 70. You have bulls who bought the close of 68, disappointed on 69. They may look to sell out around the 68 close, which would create a pullback and a second leg down. You can see we're testing the October 3rd low. Low of this bar, 51.25. Low of the October 3rd low, 51.25. So let's see how this bar looks in the next few minutes. Would I sell the high of 70? I would not. But I would certainly consider getting out of longs at 70 and really below 69. 70 lowers I think 70 lowers the probability for the bulls. It's a bull bar within a 2-bar tight trading range, and it's forcing traders to buy high near the high of 69. And that may discourage some bulls from buying up there, and that's why we're pulling back a little bit. Bulls don't mind buying if they're buying low in a trading range. They don't mind buying right here above this bar. That's in the middle of the range. It's not ideal, but they really don't want to buy above this bar. So buying above here would be buying above the top of the current 5-minute bar. And that's forcing you to buy pretty much in the I mean, just look at it. It's the middle of a tight trading range. Do you really want to buy up here? No, there's probably more sellers up here. And that's why we're starting to go sideways. We're right where we are. Do I think we're going to get a big reversal down? No. Starting to go sideways. You can see we triggered the high one, but a lot of overlap here. And that is concerning if you're looking to buy up here. You can take the buy for a swing, but I would not. With the tail above 70, it's a breakout, and it is the start of a channel. But I think more likely we're probably going to go sideways into the close. It's enough of a surprise, it'll probably get a second leg up, maybe in the Globex session or maybe tomorrow. But as far as right now, I think it's really better. I think this is more of a profit-taking area than a strong buy the close area. And by the way, for those of you that are new, stick around after the close because I plan on I'll toast an end of day review, which many of you have seen on YouTube. So I'll talk about all the bars, and then I'll also answer questions till about 4:15 Central, 5:15 Eastern time. So please stick around and we'll discuss the end of day and answer questions. So what do you see what's happening right here? Do you see what's going on? Everybody used 71 to take partial profits or full profits. It's a wedge. 1, 2, 3. I sold the close of 71 right before the close, and I just went flat. Whenever I take that kind of a trade, I'm betting that it's 3 pushes, 1, 2, 3. And realistically, I'm betting there's sellers above. I'm not expecting a sharp reversal down. I'm just expecting enough disappointment to retrace the majority of the bar. And often I'll look to trying to get out around the bottom third of the prior bar. And it's the same logic as selling above 69 with a limit order. Selling above 71 is your stop above. The way I often look at that trade is this. If I'm selling above a bar like 71, just ask yourself, should the market go all the way up here before it turns down? No. So if I'm selling above this bar, the market should really pause. Really there shouldn't be any follow through. So if you sell the close, you certainly shouldn't get a rally up to here. So I think a lot of traders put their stop just somewhere up here. And who knows, maybe one time out of 10, you get a random bar that stops you out, and that's life. But I would not risk more than my reward. And typically, if it's going to work, the market goes your way pretty quick. For the bears, they see a second entry sell. Now, what about buying the low of 71? I would not. To me, we're probably in a trading range day overall, and I suspect we'll get a deep pullback. In other words, I do not think we're going to close on the high of the day. Take a look at some questions in the GoToWebinar. How would you re-enter after taking partial profits at 51? Here. So how would you re-enter if taking partial profits here? 50 and 51 was a strong enough breakout. You'll probably get a second leg. So if you sold the high at 50 and sold more higher, what are you going to do on a retest of 50? You're probably going to buy back shorts, which means it's a decent area to buy. Now here you have 2 legs up in an overall trading range, testing the breakout point 46. That's less reasonable of an area to buy, and that's why we went sideways. But I would not trade right here. You're right before the FOMC report. That's pretty dangerous. At the moment, Mark asked, is the room only over the ES? At the moment, this trading room is only over the ES. And who knows, maybe at some point in the future, there is a DAX version. But right now, it's just covering the ES. So 72, pulling back. Traders bought the close. Some scaled in lower, deciding whether or not to get out, break even. I think we're probably going to be sideways into the close. 2:30, which is Central Time, which is bar 72. Typically, if the market's going sideways with overlapping bars at 2:30 or bar 72, it's usually better just to wait until tomorrow. It's very easy to make mistakes, and at the end of the day, there's a greater probability of lower probability events happening. So I would just wait until tomorrow. Another question to ask yourself is, if you were trading at, let's say, 2:30, you have to ask yourself why. If you're trading at 2:30 and bar 72, are you trading in order to make up prior losses of the day, or are you trading just because you want to? And a lot of times traders will trade all the way into the close because they're trying to make up for prior mistakes on the day. And that is just a really big mistake. That's a really big mistake. Broke above the high of 72 and finding some sellers. So no surprise. Someone asked what bar number do you think should be the last signal bar to take on any day? Ideally, if bar 72 is in a trading range, which I think this is forming a tight trading range, I think it's better to stay flat. So I would say, I don't think there's going to be a great signal bar to set up for the rest of the day. I mean, it's probably going to be better for most traders to just be flat at this point. Here's a good question someone asked. Okay, question. If I can only focus for 1 to 3 hours every day, should I stick to only one setup, question mark, even if that means ending days without taking any trades? I like breakouts, but these are quite rare during the first 3 hours. Well, I would understand, I talk a lot about this, and one of the challenges traders have, one of the challenges overall traders have, especially traders that are aspiring to be discretionary traders. And when you think about it, there's really two extremes of trading. There is a discretionary trader who just looks at a chart and just does whatever they're feeling. And then there's the other side of the coin, which would be, some sort of algorithm at a hedge fund or something that's very specific. It's buying, it's doing a very specific thing with logical reasoning, and there's no bending of the rules. The vast majority of traders are going to be on the other side. They're going to be discretionary traders. And the key is figuring out how to be a little bit methodical with what you're doing. If you're someone like Al and you've traded for 30 years and you've got a lot of experience under your belt, you can just trade however you're feeling every day by looking at the bars. And that's because subconsciously he is so used to trading. He's got a mental framework of how he trades everything. 3 legs up, he takes profits, waits for 2 legs down. You hear it all in the video course. Most traders are not at that level. And therefore, most traders do not have the ability to make all those decisions for the entire day. I think if a trader really wants to be profitable sooner than later, they've got to figure out how to be more methodical with their trading. And that typically means trying to take 1, maybe 2 setups every day until they get really, really good at those few setups. And then they can start taking more setups. And based on your question, you mentioned that you like trading breakouts, but there's often not any breakouts in the first 3 hours of the day. And I think what I would ask you to do is quantify better what a breakout is to you. Is bar 4 a bull breakout? Yeah. What about this? That's a breakout. This is an outside down bar. It's a breakout to the downside. And we got a second leg. The other thing I would tell you is, in general, whenever you get a breakout like bar 4, there's a 90% chance you're going to get at least a second leg that will be close to a leg one, leg two. It may not go there, but it might be close. So here's a breakout, pause, pullback. In this case, it did go up to a leg one, leg two. But the point is, there's a 90% chance that there's buyers below the first pullback, and you'll get at least a second leg. And that happens all day. Big sell-off, pretty much a 90% chance you'll get at least some form of a second leg. Breakout, 3 bars, 90% chance buyers below for a small second leg. This one's not ideal, but that's how I would see breakouts. But as far as, I think you have the right idea overall. Most traders are going to be better off trading part of the day and looking for a few setups today, a few setups every day. What is your routine to stay focused and present in the now moment with the trading range or with the trading? Let me back up. What is your routine to stay focused now in the moment while you're trading? I like to view things from the market cycle, and I like to be more engaged with what the market's doing than what trades I'm placing. And there's a little bit that takes a little bit of time to really develop that. What I mean by that is watching the market, evolve as far as the day and the bars reveal itself, and being very calm about it. So here, spike, we're channeling up. The bears are trying to get 2 legs down, test the bottom of the channel, but it's too late in the day, don't do anything. Here, I mentioned doji, so it's probably going to have a lot of trading range price action. We tried to break to the downside, we reversed, we broke up to the upside, but big bar, we reversed down, so it's probably going to get a second leg, things like that. But I will say, the longer you trade, the easier that becomes to do, and just the more easy it is to stay focused. And that's just a muscle, it's like working out. The more you work out, or the longer you run, or the more frequency you run, if you run every other day, it's going to be easier to have more stamina with running. So I would say it's just like with anything. I would be more focused on figuring out what the market is doing. What's the legs? What's the market cycle? And speaking of market cycle, I'm hoping to host a webinar, if you will, discussing the market cycle. And it's going to be for members that have purchased the trading course. Hopefully it'll be next week. But my plan with that is to review the market cycle videos. Maybe we'll take the bullet points in each main market cycle video. We'll talk about it. We'll compare it to charts, and maybe, have a hour-long discussion over the market cycle with various examples. And then I'll answer questions regarding the market cycle. And my goal with that is to try and discuss how to tie in using the market cycle while trading. So if we have a trading range and then we break out to the upside, we get a deep pullback in a second leg, or you get a breakout with 3 pushes up. What do you look for? Things like that. And again, that's going to be for people who own the video course at the moment. And part of the reason for that is, number one, if we're going to be discussing pieces of the video course, it's only fair that that is reserved for people who have purchased the video course. And then if you haven't watched the video course, it's probably not going to be that helpful. So be on the lookout for that, and you'll probably learn more. You'll probably hear more about that relatively soon. And just like you found out that there was a free trading room session today, however you discovered that, you'll probably find the same as far as this webinar. Again, I would just wait until, I wouldn't do anything else here. I think it's better just to be flat. Can you please suggest some hard and fast rules struggling traders should stick to until profitable? Example, only entering with stop orders above and below bars, take max 3 trades per day, or aim for a reward of twice your risk. I think most traders should focus on there's a couple of things. One, if the majority of the bars are above or below the moving average, only trade in that direction. Ideally, the second, only trade with stop entries. And then third, I would stick to a position size. And then other than that, I think it's really important to recognize small pullback trends or strong trending behavior. So when you see something like this, don't start selling. Or when you look at this, don't sell. Just because you start seeing trend line breaks, don't start selling. It's just so common for traders to, and they do it all the time. You know, there's a section in Al's book. For those of you that have read Al's books, the audio books were released a while back, and I've been listening to the trend book on Audible, and I really enjoy it because I can just, on my phone, I can have the chart up while listening to it. And I've read it before, you know, at least a couple of times. So it's nice to get a refresher on the information. But anyways, there's a part in either, I think it's the reversal book, but I remember Al mentioning that the moment a beginner begins to stop fading strong trends, in other words, stop selling when the market's in a bull trend, when a beginner stops doing that, they all of a sudden stop losing money in bull trends. And then eventually the beginner decides to start buying in a bull trend. And all of a sudden they realize how to make money in a bull trend. The point with that is a lot of traders get chewed up over and over and over again because they end up inevitably, what they do is they look at breakout bars like 11, they buy it and they hold on, hoping for a measured move up. They say, okay, Al says buy the close, put a stop below 11 and go for 1 times the risk. So they do that. And then the market goes sideways. But what they fail to realize is it's a 2-bar reversal. And then they don't get out here. They get stopped out. And then they say, I'm never trading breakouts again. It's a trading range. I'm just going to fade everything. And they keep doing that. And what ends up happening is, by the way, if for those of you regarding the trading room, there is only one way to purchase the trading room. You have to go to the brookspriceaction.com website, log in and purchase it. You cannot send anybody money to purchase the trading room. And just there's a little bit of issues with that. So for anybody that is considering purchasing the trading room, if somebody reaches out to you saying, just send me money and I'll give you access, it's a scam. The trading room is only accessible through the brookspriceaction.com website. And I believe it is still set up to where you just every month, you just resubscribe, you put in your information and pay for it. I do not believe it's reoccurring. Anyways, back to what I was saying. What's really important, what beginners end up doing, they trade breakouts, but they hold on for too long. They end up buying 45 and then getting stopped out. They sell 46, they sell 47, the big bear bar, and then get stopped out. Then they start fading everything. They buy and scale in, they sell and scale in, and all of a sudden they think, wow, I'm making money. I've really got this figured out. But then this happens. They sell, and all of a sudden they sell more, and they get this huge loss, and they just can't bear to take the loss. And then they end up holding all the way short. Or it is a 5-minute chart. They just keep selling all the way up, saying it's not a small pullback trend. There's no way. But look at the moving average. Find one close below the moving average, maybe here. So 1 bar out of 80 or 60 bars, however many this is. If 1 bar is closing below the moving average, it's a strong trend. So back to the question, what are some really important things that beginners should learn to do? Beginners should learn to not fade. When the market has 20 or more bars above the moving average, consider it a strong trend and only trade in that direction. The other thing is learn what major trend reversals are. It's really hard to actually get a major trend reversal. And most major trend reversals are really minor reversals. They're not major. And the reason they're not major is because most major trend reversals just go sideways. Someone asked about information regarding the audiobooks for reversals and ranges and when they'll be available. I think I think it's available. I think they're available on Audible. However, you just go to audible.com and they're there. But I may have misread it. It may have just been like a pre-purchase deal. Ken, who manages the trading room on Discord for the trading room chat, just typed in the link for those that want to sign up for November. So if you go to the trading room chat, you can sign up. Otherwise, if you want to sign up, you just go here. Let me just show you. And just to be clear, there's no tiered. The trading room is all the same price. So if anybody's, the simple rule of thumb is you have to go here to purchase it. You got to log in. And then just once you log in, click on trading room and there's a way to purchase it. So Ken said the November subscription is actually available if you want to purchase it. So if you go to, there's two places. If you're in the Discord, just go to the trading room chat and you can see it. Otherwise, you can just go here. Let me just log in. Click the login button. And if you're new, I think you have to register, but you pretty much just have to type in your email. Once you're logged in, let's see here. If I click on trading room, this is what shows up. And then you can see link on how to join. If you click on that, takes you to all of this. This is just all the disclaimer and everything like that. It's always through PayPal. You can't pay somebody money. Here's the November. There's a sample. For those that want to sign up, you just click here to sign up for the November 2023. And you'll see it right here. If you look at group membership, this is the payment group. Click here. You just click subscribe to the group. And then you can see right here, just double check, make sure it says November 2023, Brooks Trading Room, $99. And then you just click the PayPal button. I'm not going to click it because I don't want my information to show up, but you just click the PayPal button and you'll be subscribed. And then if you want in the future, you should get an email every day every day for the link. If you don't, once you're logged in, just go to Brooks Price Action, log in, click Forms, and you should be able to go right here to the Brooks Trading Room private group. Click the link, and in the morning, click on it one more time. And this link will change every day. That'll be the link for the webinar. By the way, when you want to watch the recordings are very helpful. And when I was I was probably in the trading room. I'll talk about that in a second, but here you can see the October recordings. I can click on this and I can see every recording in October. So I can click on whichever one I want and it downloads. So if I click on Friday, it'll download to my computer and then I can watch it. One of the things I'll say about the trading room is, so I started studying now, most of you know, I started studying now around 2013, and I was in the trading room. I think I started watching the trading room either in 2013 or 14, but I was in the trading room for a better portion of, 6 years, quite a few years. And what helped me the most, obviously reading the books, watching the video, of course, but I was fortunate enough to be able to listen now pretty much every day in the trading room. And what I started to pick up on through the years of listening down in the trading room was his demeanor and the way he talked about the bars. He was very calm about everything. And what I started to realize is his demeanor and calmness was a reflection of his discussion that the market was 40-60. So sometimes it's closer to 40 and other sides closer to 60. Other times it's very close to somewhere in the middle. In other words, a lot of times the market most of the time is 40 to 60%. One of the biggest problems traders have, and this is what I'm getting at with the video with the trading room, is traders a lot of times will be almost unable to even fathom the possibility that they're on the wrong side of the trade. Whenever you look at the market and you think, yeah, there's no way I'm wrong, you are on the wrong side, and you're mentally on the wrong side of the market. Because at any given moment, you should always assume, there's a few things I always think about. One, there's a 20% chance a crazy bar could just appear out of nowhere and stop you out. So always have a stop in the market and always respect it. The second one is always assume, no matter how strong your trade you think you're in, always assume there's a 40% chance that you are on the wrong side at a minimum. Anyways, back to Al. The trading room really helped me with getting a better mental mind frame of the way Al talked about the market. He was always so calm about the market and very at peace. The other thing is it's really, really helpful. What I would do is download the recordings and really listen to them. So for me, it's easy to miss things during the day. You hear Al talking and you're thinking about your trade. I'm short and I'm really nervous that this is going to fail. So I'm ignoring what Al's saying. But then when I would go back on the recording, I'd say, wait a second. Al was telling me to hold through this. And this is actually a good question. Lucid asked, how do you avoid being overly dependent on the trading room? I remember for years, I would listen to Al, and it was almost like training wheels on a bike. I could not ride the bike without Al being in the room. I couldn't think straight. I couldn't even do anything. But at some point, the longer I listened to Al, the more I started to, it got to a point where, as I said, at some point I could watch the market without having to listen to Al. But then another thing that happened several years down the road was eventually I got to where I could listen to Al in the room, but not be influenced by the trade I was taking, where I could listen to him, but not panic. And the reason for that is if you're listening to Al and you're long and Al's saying, I wouldn't buy up here, you have to understand he is talking from maybe a scalping mindset, or he's talking from the 40 to 60 framework. Just because he's saying that, it's a low probability buy does not mean it's a bad buy. So the longer you listen to anybody, you listen to Rose long enough, you listen to me, you listen to Tim, eventually the longer you listen to somebody, you'll begin to be able to filter what they're saying to the proper degree. And you'll begin to understand, for Al, I started to learn at some point, there's little nuances he would say. And just because he says them doesn't mean it's wrong to think the opposite. But that's just his way of expressing his belief about the market. But those frustrations you feel in the trading room, for me, it took about 5 or 6 months. I knew the trading room was teaching me quite a bit. However, it took me about 5 or 6 months when I started watching the trading room and listening to Al to really get comfortable with listening to him during the day. But during that 5 or 6 months, I would listen to him during the day as much as I could. So you can see we're holding above the October 3rd low. That's good for the bulls. So typically on these end of day reviews, I'll talk about the daily chart, sometimes the weekly chart, and then the 5-minute bar by bar, and then I'll answer questions. So feel free to ask questions at the end. And someone asked about the videos. The videos are edited. The videos that I was showing up here, when you click on the link and it downloaded, it edits out any time that there was no talking. So instead of it being an 8-hour video, it's about a 2.5, maybe 3-hour video, depending on how many people are talking that day. But it's the video and the audio. So on the daily chart, so far, good for the bulls. Is it always in long? I think it's always in long, but we could easily get a deep pullback and then a second leg up. But at a minimum, I think we're going to test the top of the channel. So strong enough breakout, probably buyers below for a second leg. Kind of like right here, bull breakout. We had a pullback, but the pullback led to a test of the highs. What are the chances that we get a micro double top and then another downside breakout? I don't think that will happen. I think that's lower probability. We came close to the measured move from the high of July 27th to the low of August the 18th. And we came close to it down here. But I think we've probably seen the low for at least some time. And we'll probably get 2 or 3 legs up. And as of course, I did it again. So let me shuffle it around once again. I probably will go back to the legacy version of TradeStation. Five-minute chart. We had a continuation of yesterday's bull channel. We formed a parabolic wedge. 2 legs up, we broke to the upside and then formed a truncated wedge. Broke to the downside, tested the bottom of the channel down here, and then pretty much went sideways until the FOMC report, and then we got a large second leg. So you can also say that this sell-off here was just a trend line break from this. Here's the channel. Channel broke out to the upside. You could draw the channel like this if you wanted. So we broke above the top of the channel, reversed down, tested the bottom of the channel, and this channel, again, tested to the upside. That's one way to draw it. So first bar of the day, we have a bear bar after a gap up. And I'm going to switch the screen really quick. Give me just 2 seconds. And ignore the clicking for a moment. So bar 1, we gapped up. Here's a, you can call it a breakout. Here's a wedge, 1, 2, 3. We broke above it, reversed down. We're testing the breakout point of yesterday's high. What about selling below 1? Selling below 1 in general is a low probability sell. And because of it, there's probably more buyers below 1 than sellers. Typically, bar 1 is a low probability, there's only a 20% chance bar 1 is the high or the low. And I want to say one thing that I talk almost every day about regarding the open. Most traders are going to be better off. They're going to hate to hear this, but it's just the truth. Most traders are going to be much better off waiting for 6 to 12 bars before placing a trade. I know everybody's excited on the open. You know, you want to trade. You've been waiting all morning for the market to open, and you're feeling really good. But most of the time, the market forms a trading range on the open. Therefore, if you just stop trading the first 30 minutes every day, at least the first 6 bars, maybe the first hour, and then after bar 72, stop trading, you're going to really help yourself quite a bit. So bar 1, only 20% chance it's the high of the day. Bar 2, it's an inside bar. And also when I'm trading, I like to give myself room above. I don't like the chart to be up here because it gives the illusion that the market is going to top out because it's at the top of the screen. I like to move it down just to remind myself we can go a lot higher. Bar 2, inside bars are trading range bars. They're triangles on smaller time frames, so it's a breakout mode pattern. Probably sellers above, buyers below. Bar 3, we have a doji. 3, it's a doji, still probably sellers above 1, sellers above 2, probably buyers below 3. And then 4, we have a give up bar. Strong enough bar for the bulls, probably going to go at least a little bit higher. but let's see what the follow through looks like. And then 5, there's your follow through. So instead of traders eagerly buying the close of 4, hoping for higher prices, what did traders do? Instead, traders bought a pullback. They bought a 50% pullback of the bar and then took partial profits. So it's possible that we go sideways here. Disappointed bulls, they'll look to sell above 2 or maybe sell a little bit higher, betting on a trading range. And then you can see 6, we sold off, testing the breakout point above 3. We didn't close it, but we did close the breakout point above 1. And that's a sign that the market, that this is a bull leg in a trading range. 7, almost not quite outside down, but there were sellers above 6 and sellers above 5. So what did bulls do? Bulls, they bought the close of 5, they bought more lower. Some got out above 6, we're at the high of 6, others got out a couple of points above 6. Now we have a wedge, 1, 2, 3. But when you look at that, it's parabolic and minor, and there's a big tail below 7. That lowers the probability of traders selling below 7, increases the probability that there's buyers below 7. That is very weird. This is not the way the 5-minute on my other computer looks. I'm going to refresh the chart. I want to see something. Whenever there's a data discrepancy, bar 6 is not the same bar 6 I have on my chart. So whenever that happens, on my other trading computer has a totally different bar. So whenever that happens, I always go to the CME website and I look up the quotes. Well, my other trading computer has a totally different bar. So whenever that happens, I always go to the CME website and I look up the quotes. So I go to the CME website, there you look at the Emini quotes. Here's the December contract. 5-minute chart. Interesting. So in this case, mine doesn't quite look like this, but this is still different than this. So there's some sort of data discrepancy with these few bars. That's not the end of the world. It's just a matter of this bar did not exactly look like this. It's a little bit different. Let's see if we go to let's try this. So if I go to the Globex chart, same thing. Oh well, it'll probably be corrected sometime during the overnight hours. But that is not the end of the world, and we'll move on. So we have a bear bar on 8, but still bad entry bar. 9, bulls buying. It's a breakout pullback buy. You can call it a high one buy above 8, probably sellers above. But because we're in such a tight bull channel and we're holding above the moving average, bears might get trapped selling above, and we may continue higher. And then 10 consecutive bull bars, possible micro gap. The high of 8, 28.75, low of 10, 29 even. So there's a 1-tick gap that's open, and we probably will test the high of 7. So consecutive bull bars, probably always in long, going at least a little bit higher. And then 11, a strong bull breakout, strong enough bar and reasonable by the closed bar that the market's probably going to go at least a little bit higher. What about buying the close? Some traders will, but it's also an exhaustion bar, and it will increase the chances of profit taking here in the next couple of bars. 12, a bear bar. It's an inside bar, probably buyers below 12, scaling in lower. What are the chances it's a wedge? Low probability that it's a wedge, so probably going to go sideways. But if we start to get 2 or 3 bear bars closing on their lows, you will have traders begin to exit out of their longs. But at the moment, 11 is a strong enough bar, probably a second leg up likely. 13, high one buy, probably sellers above and a second leg down. Likely, high one buys often lead to deeper pullbacks, but high one buys should be thought of as trend resumption bars. And what that means is more often than not, high one buys lead to minor pullbacks and then higher prices. 14, another bull bar, second leg up after 11. Consecutive bull bars, probably buyers below 14. And then 15, another bull bar breaking out above 14. 3 consecutive bull bars. Is it by the close? It probably is, but we're probably going to go fairly sideways fairly soon. If you see 12, 12 is a bear bar. And then is a bad follow-through bar after 11. And that increases the probability of sideways fairly soon. Also, on the open, you know there's a 99% chance that you're going to get that the market is going to touch the moving average. And because of that, 99% chance we're going to reach the moving average fairly soon. Because we have a trend from the open, there's a 60% chance that this trend from the open will evolve into a trading range. And only 20% chance that it's a bull trend lasting all day. We have a possible measuring gap, low of 1, high of this bar. And we also have a larger measuring gap, maybe the 7 low to the 69 high projecting up. And then 17 outside down, enough of a surprise, probably at least a small second leg down likely. For the bulls, for the bears, the high of 17 is a second leg up after 11. And that will cause some bulls to exit below 16, betting on a second leg down. And you can see we're getting really close to the blue line, which is the top of the daily chart, which is the blue line on the daily chart here. 18, weak, breakout below 16, probably sellers above for at least a small second leg down. Excuse me, that was 17. 18 is a bull bar, but probably sellers above for a second leg down. And then 19, you can see some of the bears who sold below 16 or the close of 17, disappointed with 18, getting out around break even. What about buying the close of 19, betting on a second leg? There might be more sellers above 19 than buyers. You're right at the close of 15, and that's an area where bears will begin to sell again. Bears will sell and bulls will buy to take profits. Possible wedge, 11, 16, and then somewhere up here. And then we paused on 19. We paused on 20. 19, we broke to the upside. 20, we pulled back. So it's a trend line break of the bar 19 breakout. And that will reduce the probability for the bears and increase the probability of more sideways trading. 21, big bar breaking out below the tight trading range. For the bears, it's a 2-bar reversal. We rallied on 11. We sold off on 21. That increases the probability that the market will go more sideways, increase the probability of a second leg down, and maybe a test of the 9 close. But we're right at the area where bulls originally got trapped, this breakout point. So this might be more of a buy zone than a sell zone. 21, 22 consecutive bear bars, but holding above the moving average. Probably at least a small second leg down likely, and that will limit the upside. You have bulls who bought the 19 low or the 13 low in here during 21. They'll probably use any rally to look to exit. Let me just move this out of the way. 23, 3 consecutive bear bars, but bigger tails and smaller bodies, probably sellers above for a second leg down. 24, an inside bar, low 1, but probably buyers below. And then another inside bar, 25, so a possible 2-bar final flag. It's a triangle. If we break to the downside, we may reverse up. 26, we broke to the upside, pulled back, and then 27 is another bull bar. What about buying above 27? Some traders will. It's a possible second leg trap, leg 1, pull back, leg 2. But the sell-off on 21 to 24 is strong enough, it'll probably get a second leg down, which means that this breakout point, the 18 low, is a possible measuring gap. So we may break below these lows and get a second leg. 28, a doji, probably sellers above. It's a micro channel since 24, but it's weak compared to the sell-off down to the 24 low. And then you can see there were buyers below 28 for another leg up. But now we have a push up and a pause, another push up, pause, and then another push up. So it's a wedge at the high of 29, and there might be more sellers above than buyers. 30, a small bear bar. Looks very, it looks like a small bar and meaningless, but it's actually very important. So since it's a wedge, we could easily break to the downside and test lower. For the bulls, they want a bull break out of a wedge and a test up here. And then 31, a bear bar. But because the rally up to 29 is tight, there might be more buyers below 30. The bulls that bought below 30 are trapped on 31. And that means there might be more sellers back at the 30 low. And that's exactly what happened on 32. We rallied testing the 31, the 30 low, and then we sold off again. 3 consecutive bear bars, probably sellers above for a second leg up. It's a bad stop entry buy, which probably makes it a better limit order sell. 33, bear bar closing below 32, closing on its low. What about buying down here, betting on 3 legs down, 18, 23, 33? I would not. 33, the sell-off from 30 to 33 is a decent second leg down. Plus, we may get a more comparable leg 1, leg 2. Sell-off, pause, and a second leg down to the 9 low. Also, because today is mostly a trading range day, we may test the open of the day as well. So we could easily sell off testing the open of the day. 34, bear bar, possible failed breakout below 33. Bulls who bought the low of 32, scaling in lower, but because the channel's tight, the first reversal up will probably fail. 35, broke out above 34, but we couldn't even get a bull bar, and it's a doji. What about selling? What about buying below 35? It's a low one short. Some traders might, but the channel down from the 30 high is tight, and that will reduce the probability of traders buying down here. 36, doji, bad stop entry buy above, so probably sellers above. And then 37, we broke above the 35 high, so it's 2 legs up. We rallied to the 35 high, pulled back to 36, second leg up to 37, testing around the midpoint of this sell-off. What about buying the close of 37? I would not. If anything, I think you're selling the close of 37, betting on a 2-legged pullback and a second leg down from the sell-off to the 34 low. And then 38, bear breakout, breaking out below the channel, 23 low, 34 low, and then down here, but still may have to get to the open. And then 39, follow through, but a close at the midpoint, testing near the 8 low, bottom of the channel. When we came within 3 ticks of the open of the day, typically when the market comes within 3 ticks of testing the open, usually the market has to get closer to the open, especially when the day looks mostly like a trading range. So what about selling the close at 39, betting that the market has to go lower and test the open? I would not. It's 3 pushes down, 1, 2, and 3, and it's a failed breakout below a channel. We could easily reverse up and test the top of the channel. So we could take a parallel, draw it up here. We could easily test up to 24, 42, 34. 40, bull bar, failed breakout below the channel. What do the always in bears do above 40? I think it's reasonable to get out and wait for a couple of legs sideways to up. 41, weak entry bar, but it's a bad low one short for the bears, so probably buyers below. 42, doji, micro double top, 41, 42, but still with 4 consecutive bull bars, probably buyers below 42 and a second leg up. You're testing the breakout point, 34 low, 36 low, so we may go sideways here. 43, bear bar, testing the 39 close, probably in the buy zone, probably not going to go much lower. And then 44, second leg up from the rally to the 42 high. Strong enough bar, we may go a little bit higher, but probably not much higher. Still targets above the top of this channel. 45 consecutive bull bars. For the bulls, it's 2 legs up, and they want a test of the 30 high. And the bears, they're hoping it's a second leg trap. Rally to 42, pull back 43, 2 legs up, 44 and 45. And the 2 legs up, 44 and 45, have tails above the bars. So that will lower the probability of the bulls buying up here. So what does that mean? If you look at 11:15 to 11:20 on a 1-minute chart, it's actually 12:15 to 12:20. We can see this. Rally, pullback, rally, pullback, rally. Bear bars, it's a parabolic wedge. You don't have to see that though, because you can imply it on this chart. 46, possible second leg trap, probably buyers below and a second leg up with 44 and 45, but instead of getting a second leg up, it was a second leg trap, and we broke to the downside on 47. 47, strong enough downside breakout. We'll probably get at least a small second leg down, likely, but you're at the bottom of a trading range. Because the channel down is tight, this was a 2-legged pullback. What do you think the traders are going to do down here? They're probably more interested in buying back shorts than selling to establish shorts. And I suspect a lot of the bulls feel the same way. Bulls are probably buying down here. Strong enough bear bar, first reversal up will probably fail, and we'll get a second leg down. 48, a bull bar, but because the bulls are trapped, they're probably selling above 48 rather than buying. And that's why 49 looks the way it does. 49, second leg down after 47. Probably buyers below 48, buyers below 39, and buyers at the open of the day. And then 50, inside bar, second entry buy. Okay, swing buy, but we're so close to, we've only got about 20 minutes until the FOMC report. Most traders should be flat at this point. 51, follow through, testing the breakout point, 46. And then you can see we pulled back, so that's disappointing. The bears who sold above 50 and more higher, making money. Looks like a trading range day. 53, a second leg up from 50 and 51. But again, you're right at the report, and there's no reason to be trading in here. 54, inside bar, probably breakout mode, waiting for the report. We're right in the middle of the day's range. And you can see we rallied to the top of the channel, the 30 high. We tested near the bottom. Trading range bar, probably going to go sideways. 56, an inside bar, probably sellers above, buyers below, but it's a trading range bar. And because of that, 50-50 chance, depending on the breakout, 50-50 chance we go up or down. 57, bear bar, closing on its low, probably buyers below and more sideways. Excuse me, let me back up. 57, breaking out below 56. It's an okay swing, sell, betting on a test at the open of the day, but you're at the bottom of a trading range, and it's a possible second leg down. 54, 55, pullback, 56, and 57, second leg down. 58, we tested the 49 low and reversed up. A lot of traders that sold, and here I mentioned that I took the sell, and when it went down and started to reverse up, a lot of those traders bought back their shorts. 58, bull bar, a third failed breakout of the open of the day, and a test of the open of the day. Reasonable to exit shorts above 58. And reasonable for the bulls to go long above 58. 59, consecutive bull bars, breaking out above the moving average, probably a second leg up likely. And 60, a pause, so it's a disappointment bar. We'll probably go at least a little bit higher, but it's a reminder that something is not right in this bull trend. And then 61, strong bull bar, testing the highs. What about buying the close? Some traders might, but if they do and the market doesn't race up quickly, a lot of those bulls will look to exit. And that's what happened on 62. I mentioned that 61 on the open of 62, the market went down to about 42.37, stalled in the first minute, and then reversed up, testing the close of 61. So traders were able to buy, scale in, and get out break even. Then the market sold off again down here and closed where it did. And that's a reminder. If you're buying high in a trading range and the market doesn't quickly go your way, or if you get a deep pullback before the market goes your way, a lot of those traders will go ahead and exit. And because of that, because the market sold off and then retested the close intra-bar, there was a greater risk that if the market did sell off again, it would trap traders who were buying, who were still long, hoping for an upside breakout. 62, on the close of 62, it's an okay sell the close bar, betting on a second leg down. That's what happened on 63. 63 tested the open of the day in these lows, and because the bar was so big and the tail on 62, you had a lot of traders buying as the bar was going down, especially at the open. 64, doji, probably, we triggered the buy below 63, probably sellers above, buyers below, but overall tight trading range. We had a strong enough breakout to 61 and then a pullback below 58. It's possible that the bears on 62 and 63, it's possible that's just a pullback and we'll test the high close of 61. 65, bull bar, and then 66, another bull bar. We rallied on 64, sold off, rallied on 65, sold off, and then we broke above the bear flag of 64 and 65. We broke above it on 66, and we tested the high close of 61. 66, probably a strong enough bar. We're probably going to go at least a little bit higher, and at a minimum, I think we'll probably get to the October 3rd low. And then 67, follow through, 3 consecutive bull bars, but tails all the way up, and we have tails up here. That will reduce the number of traders buying up here. And then 68, an inside bar. It's a high one buy with a lot of trading range price action, but the breakout up to 67 strong enough, will probably go at least a little bit higher. However, there might be more sellers above 68 and the market pulls back first. So sellers above 68, and we pulled back on 69. 69, bear bar closing on its low, probably buyers below, scaling in lower. But because it's a bear bar, we could easily test the high of 62, and even deeper than that, maybe the high of 66. So I think it's okay for bulls to exit below 69 and wait for a stop entry to buy. The reason for that is too much risk that there's sellers above. And then 670, I mentioned it's a high one buy, and there'd probably be sellers above, but also mentioned that 70 became too big of a bar. And because of that, it would reduce the amount of traders buying above 70. 71, bull bar closing on its high, but a possible wedge. 67, 69, and then the 70 high. That dramatically increased the chances. 69 increased the chances that there were sellers above and sellers on the close of 71. 72, outside down. You can see more bears sold the close than bought it. What about selling the close of 72? Some traders will. What about buying it? You can, but the reality is there's probably sellers above 72, and that will limit the upside. 73, we broke above it, but pulled back, and then we pretty much went sideways into the close. For stop entries, I thought it was okay. Some traders will buy above 4, and if they don't buy there or they get out a few bars later, they probably buy again above 9 or maybe even better, 10. And then I think that's okay for them to get out. I think it's okay to get out below 16. Bulls, do they buy here? I would not. Too much risk of a second leg after a wedge, 1, 2, 3, and a second entry sell. Bears, they can sell below 30, or they can wait for 33 or maybe 31. And then if they do, I think they get out above 40, or they get out above 44. And if they do, what do traders do on 46? 46 is a 20 gap bar sell, but it's probably a lower probability sell. Some traders will take it. I think it's okay to get out of longs below 46. And if you don't, you probably get out as 47 is breaking out to the downside. And then probably an okay buy above 50, but it's too late in the day. It's better not to do anything with it being the FOMC bar. And probably an okay buy above 58. And if you get out below either during 62 or on the close or below 62, I think traders buy again, maybe above 65, whereas the market starts to rally. And that's pretty much it. And that's pretty much how I would trade always in. For limit orders, I thought probably buyers below 2, sellers above 1. Probably buyers. I thought a good, reasonable limit order, buy below 5, maybe buy below 7. And then if you were selling here, you got trapped. So it's a good buy. Probably buyers below 12, sellers above 13, sellers above 17 or 18 for second leg. Probably buyers below these lows, but then there's probably sellers above these bars. And probably sellers above 34 for a second leg down, but probably buyers below 35. And probably buyers below 42 for a second leg up. But then probably buyers below 47, or excuse me, probably buyers below 48. We sold off on 47, rallied 48. So if we fall below 48, that would be in essence falling below the first leg after a pullback. And that'd be a greater risk of reversal up because it'd be 2 legs down. Leg 1, pullback, leg 2. And probably sellers above 51 or 52. Probably buyers below 55 down here. And maybe sellers near the highs, which obviously there were. And in here, buyers below 58. But all of this, you need a pretty wide stop if you're trading. For buy the close, sell the close, I thought it was probably buy the close of 10, maybe buy the close 22, but right at the moving average, not ideal. I thought maybe sell the close 33 for a second leg down. And if you sell the close at 38 or 39, which is the third leg down in the trading range, it's not ideal. If you do, reasonable to just get out, break even. And as far as buy the close, sell the close, not really all that clear. Maybe buy the close 66, 67, but not many bars left in the day, plus a lot of trading range price action. So where do we go tomorrow? We had 3 consecutive bull bars right at the moving average. The bears, they want to disappoint the bulls and create a bear bar, but I suspect the first reversal down will fail and lead and be minor. That also means there's probably buyers below and the market will get a second leg up. But we'll see. If the bulls are lucky, they'll be able to get another strong bull bar today. So the bears, they want to disappoint the bulls and create a weak follow-through bar or a bear bar. And then the bulls obviously want another bear bar. They really want the market to gap up tomorrow, creating a gap and not testing yesterday's close and being a strong bull trend bar. But we know that's probably less likely, more likely something disappointing. Okay, let me take a look at questions. All right, so question, let's see what we have here. Question, is there one trade beginners can focus on to make money while learning on a daily basis in the trading room? Well, yes and no. And it really depends on where one's at. I think there's a few really important things to learn. One is what I talked about as far as leg 1. Leg 1 has roughly a 90% chance of getting a second leg in that direction. So if you can learn to spot what a strong breakout is, typically 90% chance you're going to get a second leg. The other thing I would do is, for one, let's just go to the video course. So I'm starting out, and let's say I've seen the video course already. What I've got to realize is, here's the challenge of trading. 59 hours of fundamentals, 38 hours of how to trade, Yeah, I guess that's about right. I mean, it's basically 100 hours of the trading course, plus you've got an extra 10 hours. So you're about 110 hours, 108 hours. That's if you don't include Forex. So 108 hours of pretty detailed information, plus the market is not always the same. You know, if you're dealing with computers and you're reading a book, or you're watching a course about computer modules or whatever, and there's 108 hours of videos, there's not going to be various, it's all going to be the same. If you're learning how to build a car or an engine and you're studying a course over how to build an engine, it's all going to be the same every time. The market, it's kind of like melted plastic. No pattern is going to look exactly the same. And because of that, it becomes a little bit challenging as to how to digest all this information. What I would do is I would start with, once you've watched all the videos, I would really begin, if I could trade during the day, I would watch the Trading the Open videos, and I'd get a really good familiarity with this. I talked about this in a YouTube channel. I think it was July the 6th, back when we all talked about the encyclopedia about Trading the Open. But I would think through how to categorize things. So how to trade, what are the different types of the opens? Next, I would understand over here the market cycle, which we're going to discuss hopefully next week in good detail and answer questions. Then I would understand always in, and I'd really understand reversals. What does it really take to get a strong reversal right through here? And other than that, I would spend a lot of time really thinking about how major trend reversals operate. Bull trend, trend line break, higher high. We tried several times. We broke to the downside. Now we have a bear trend, trend line break, lower low, and then it evolved into a trading range. I would just get really good at looking at charts. But that takes a long, long time. Question, I've noticed many times that 2 times actual risk is about 1 to 1 times initial risk. Would you think it is a good strategy to work with 2 contracts and get 1 times profit with 1 times initial risk, and after that pull the other contract at the entry price and go for 2 to 1? Yeah, so what I guess, to my understanding, what they're asking is, if they sell this close, or maybe they sell in here, they notice that the market will often go about 1 time. So if they sell this close and here's their risk from here to here as far as actual, they notice that the market will go down about 1 times the actual risk. And that's true. So the question is, can you sell, take half off at 1 times your actual risk, and then hold the balance? To me, you can do that. And a lot of traders, they use leg counting, but the more likely the market's in a channel, the more traders will begin to be quicker to take profits. So here, traders are selling a pullback, but they're hoping on a second leg down. And they think that, hey, maybe we'll get some kind of measured move. Leg 1, pullback, leg 2, which we ended up getting. Maybe it's leg 1, pullback, leg 2, which we ultimately got down here. But the more the market's in a trading range, the more the market's going to go sideways. I want to say one thing about break-even stops. Break-even stops, really, traders use them all the time, and everybody uses them. But mathematically, they don't make any logical sense. It's actually a dumb trade. And the reason for that is a break-even stop normally almost always gets hit, and there's always a better price action stop. But there's nothing wrong. Traders, when the market's moving fast, they'll quickly move their stop to break even to prevent themselves from at least taking an actual loss. But you're still, at the end of the day, giving up your profit that you had. So you're still losing money. It kind of gets in that other people's money conversation. But in general, when the market, I would count legs. And if you have a breakout and you get a second leg and then a third leg and a bull bar closing on its high, especially if it's breaking out below the channel, I would just get out. But anyways, more on that topic fairly soon. Question, do you have to buy the current month of the trading room to view old recordings? No. So if you buy the current month, if you buy, today is November the 20th, and you buy the November trading room to get access, I think it's discounted. It's like $50 a month or something like that instead of $99 because there's only so many days left or something like that. Maybe it's $75. But anyways, you would get access to all of those months. But if you want an original, if you want like January of 2023, you would select January of 2023 and download those. Is there any focus on Forex in the trading room or mostly the E-mini? It's mostly the E-mini. I'll occasionally talk about Forex, like the euro, dollar. So here is the euro versus the dollar right here. And you can see I mentioned that tight trading range. We broke below it, but we couldn't get followed through, and we reversed up. But for the most part, the room will mostly cover the E-mini. How many contracts does an institution place on a single trade on average? Do they break it in various lots? I think most traders and institutions break their positions into various lots, especially institutions. If you're building, a lot of traders will accumulate or build a position, and then they'll begin to reduce the position, and that they will typically do it in pieces. If you are a paid member, is the trading room included? I'm not sure. That you have to pay for the trading room, so I'm not sure what you mean by a paid member. Question, do you have to buy the current month of the trade? So we've already listened to that. Do new members have access to old recordings? No. You get access to the month you subscribe. So again, if it is November the 29th and you purchase the November trading room, you get all the November recordings. Can we get the recording for today, even if we haven't purchased for the current month? I think Richard said he was going to put that in the sample. So if you go to brookspriceaction.com, click on trading room and scroll below, you'll probably see this video here in sometime next week. Which books would you recommend to start with? I would start with Al's, start with the trend book, but first I'd watch the video course. Someone made a comment about saying there should be a save the layout button in TradeStation. Yeah, the problem, this computer is still having issues. For example, I cannot save and close my TradeStation. It just kind of panics on me. So I'm going to have to just factory reset it. And I've done that before. Or I'm going to have to reinstall TradeStation. I've done it before. So this time I'm just going to go back to the legacy version. How often do you show examples from the 1 minute? At least a couple of times a day. I like to show examples of a 1 minute as a better representation of what happened intra-bar. One of the things I like to do is I have a workspace where I'll create PowerPoint slides where I'll have one chart on the left of maybe a 5 minute, chart on the right of like a 2 or 3 minute, and I'll flip them around. Sometimes I'll look at a 7 minute, compare it to a 3 minute, a 10 minute compared to a 5, a 2 minute compared to a 4. And it's just a practice to get a better understanding of what bars look like in different intervals. I would never trade that way. That is just a practice of getting, reps in of looking at charts. How long can we keep these videos that are recorded in the room? So they stay on the website for about 3 months, and then they get taken down due to the servers. I guess it strains the amount of gigabytes that the videos are. It strains the website. But they're actual files you can just download and put them in Dropbox. So I've got a couple of hundred of videos downloaded just from Al through the years that are on my Dropbox or on my computer. And some of them date back to 2014. Still reading through questions. I only use the EMA with these charts. What years do you suggest to study Al? Well, it varies. If I was going to buy a recording, what I probably would do, I think you can get an entire year's worth of recordings for like $200 as opposed to $50 a month. So what I would do is I'd probably just pick any, 2017, 18, 19, and just purchase one of those and study it if you really want the recordings of Al. Is the trading room only for learning how to read price action, or is there more stuff after hours? Is there a schedule? It's just a trading room. It's on during the market hours. So basically from bar 1 to bar 81. And there's often an end of day review. I tried to find the always in long and always in short videos in the training videos, but I can't find it. Well, if you're probably looking at if you're looking at the Brooks trading course, the full course, it's in the fundamentals section called always in. So reading through, trying to find questions that maybe I missed. Yes, someone asked if I look at a 1 minute to see what the 5 minute. Do I ever look at a 1 minute chart to get a better understanding of the 5 minute bar? Sure, and I do that to better understand overall patterns and just get, kind of focus, memory, I guess, if you want to put it that way, understanding that this is a tight bear channel. This is a bear breakout on a higher time frame. Even though it's a parabolic wedge, it's tight and it'll lead to a second leg. Or this right here. It's a wedge, but the channel's tight, which means even if we sell off all the way down here, we could still get a second leg. I recall Al mentioning that the 18th bar is a key bar. Is that something you use as well? Yeah, 18 bar range just simply means that when the market is formed, the first 18 bars, typically the high or the low will get broken. So if the high is bar 16 and the low is bar 1, there's at least there's a high probability that you're going to break above the 18 bar range. And when you do, the odds are you've seen the low of the day. And that's the same with the Globex chart. So whenever here's the Globex market. On the Globex, here's the low of the Globex session. It's not true, actually. Yeah, here's the low of the Globex session. Here's the high of the Globex session. Actually, the high it's actually over here. So here's the low of the session. Here's the high. On the open, there's at least let's just call it a 90% chance that you're going to break above the Globex high or low. And really, the Globex pre-market was this high. So there's a 90% chance you're going to go above this high or this low. So that's something to think about as far as probabilities. Do you have to talk like Al to trade like Al? I'm sure you don't. But I think it's important to, I do think it's important if you're going to be a discretionary trader to think like Al. Be comfortable with both sides of the market. The bulls are trying to do this, the bears are trying to do that. Question, you mentioned in the past that you watch your entry bar carefully, and if the move is not in the direction of the first minute or two, you exit. Is this still true? Yeah, that I'll often do that, especially if I think that it is a lower probability trade and I want the market to go my way. So here's an example. So if you're buying above this bar right here, it's not a great example, but if you did, and this bar is starting to go your way, but it's hesitating a lot, I think a lot of traders will just be really quick to get out, as opposed to somewhere like here. Even if you buy, above this bar, even if it pulls back, it's still probably going to go mostly sideways. Another thing I would practice doing, someone's asking about routine, it's important to practice marking up a chart. I think traders will find that to be extremely helpful. Extremely helpful. So if there's any other questions I haven't answered, please type them and I'll see if I can answer a couple more. If there are questions I haven't answered, please type them and I'll see if I can answer a couple more. So I'm going to give it, maybe a minute or two. And if there's other questions, I'll be happy to answer them. If we mark up the chart, can we check them somewhere? Yeah, if you go to the blogs, I'm sure most of you are familiar with the daily blogs. And Al every day he will mark up a chart right here. And you can see, you can follow it along to this if that's what you're looking for. Question, curious about why more traders favor the ES, or the E-mini over Forex like the euro dollar. It really has to do with minimums. So one of the problems with Forex is, I think Forex is a great market to trade on higher time frames. It moves really well. So if you're looking at like a 60-minute chart, it's a really, really good market. 1, 2, strong buy climax, but it's late in a channel. And you can see the channel's parabolic. Maybe let me get the question box out of the way. So here's the channel. We broke above it. There's the bottom of the channel. And if you look to the left, it's testing these prices over here. There's nothing wrong. Plus, the great thing about Forex is you can trade very small. You can risk a few dollars on a 60-minute chart. The only downside to Forex is these smaller time frames. It's like a 5-minute chart, for example. If we look at a 5-minute chart here, from this bar, so the low of this bar is, let's say it's 1.053 to here is 1.054. And in this case, the bars are pretty big, but this bar is about 20 pips. So here, the range is pretty tradable. It's pretty easy to trade. My only issue is even right here, 55 to 70, that's about a 15-point range. And if you do the math, a lot of people, if they go for 10-point scalps in Forex, they're going to pay more than 10% in commission. When they factor in commission and the bid-ask spread, their transaction costs are closer to 10%, if not more. So a lot of traders, they really need to go for more, 15 pips, 20 pips. And because of that, a lot of the bars are really small. You can't buy below this bar and scalp out a few bars later. So what that ends up meaning is you have to trade Forex on higher time frames, like a 60-minute chart. If you trade a 60-minute chart, your average bar range is going to be, at least 20 pips or more, probably bigger than that. And if you do that, that will give you plenty of range relative to minimum transaction cost. But the only downside is there's less trades. If you look at the E-mini, there's all sorts of trades you can take on the E-mini. If the average bar is 4 points on the E-mini, you can, in theory, place a trade and exit on every bar. So that is the primary reason why a lot of traders trade more of the E-mini on a 5-minute chart. Question, Brad, how do you take time into account? Is that something you or Rose will say if it has to hit X in 1 to 2 bars or no good? It varies on the situation. So like right over here, let's go back to the bar chart with bars on it. So like over here, we're getting a rally. It's a bull breakout on 11 and then a tight trading range. If this is going to work, it really needs to reverse. You don't want it to last. If you buy here and the market goes sideways for too long, the bulls lose their advantage, their probability advantage. Same thing here. If you're buying on 61, if the market starts to stall up here for too long, traders will begin to take profits. And you remember I said that it sold off to about 37 and then it rallied back to the close and then it reversed down. And that's because a lot of traders, they're buying, they want the market to go up quickly. If you're buying a breakout, and you're buying because there's momentum, and if you're not getting momentum, then that means something is wrong. And if something's wrong, usually you're on the wrong side of the market. Then that means something is wrong. And if something's wrong, usually you're on the wrong side of the market. I subscribe to the trading room in October. Can I download the October videos in November? Yes. You have access for 3 months to those videos, I believe, and then you just have to download them within those 3 months. Is there a smaller than ES contract? There's the micros. Is there a smaller contract than the ES that I can trade while learning? There's the micros, and that's important. So that is all the time I've got for today, but thank you for everybody for watching and for the people in the room for the first time. It's always enjoyable to see new people. Tomorrow, it'll be interesting to see. The bulls, they want higher prices, but the bears want to disappoint the bulls at the moving average. So we'll see. All right. Thanks everybody for tuning in, and I hope everybody has a great rest of their day. And tomorrow, it looks like Al will be on in the morning. Al usually joins around a couple of minutes before bar one, so he'll start talking on the open, and then I will start talking after Al at about 12 p.m. Eastern, and I'll talk and do another end of day review similar to this. All right, thanks everybody, and talk to everybody tomorrow.